It's Friday, 4th of April, and this is your Capital Economics Weekly Briefing. What follows is an edited extract from a special client briefing held in the wake of news that China will impose retaliatory tariffs on the US, along with a host of other trade restrictions in the wake of the unveiling of Donald Trump's reciprocal tariffs plan. In this recording, you'll hear Group Chief Economist Neil Shearing hosting Mark Williams, who heads our Asia team, Andrew Kenningham, who's our Chief Europe Economist, and Deputy Chief Markets Economist Jonas Goltermann. And it starts with Mark on what China's government has just announced.
Yeah, I think it's a lot bigger, certainly, than we expected. China has reciprocated, we should say. So they were given a 34% reciprocal tariff on Wednesday, and they've hit back with a 34% tariff on all imports from the US. On top of that, there's also a number of firms have been put onto the unreliable entities list. There are some more export controls on rare earths, but it is really the tariff move that is striking because it is really big. China has never responded on this sort of scale before. This reciprocal tariff this week was the third time that China has been hit by Donald Trump with tariffs this year. The previous two responses by China, they did put some tariffs on US imports, but they were notional responses. It was really very small. And that had also been the pattern during the first trade war, that particularly as the first trade war went on, China's responses over time got smaller and smaller. So this time hitting back with 34% is really significant. Of course, 34% on what China buys from the US in dollar terms is still a lot less than 34% on what the US buys from China because of the size of the trading balance. But yeah, I don't think we should understate. This is a really big move by China.
It's a big move. So I think last year the US exported about $144 billion of goods to China. That's about 0.5% of its GDP. So clearly a lot smaller than China's exports to the US, which I think, you'll correct me if I'm wrong, but they're just over 3% of GDP, something like that, aren't they?
Yeah.
What about the rare earths controls, though? Is that something that, in a sense, it's a continuation of a pattern that we've seen over the past several years, really, isn't it? Through the Biden administration, China obviously has a stranglehold on the global supply of many rare earths that have become critical inputs to many goods. Is that a more effective way for China to push back than tariffs per se? Is that going to inflict more pain on the US potentially?
Potentially. We haven't yet had time to look at the full list of the rare earths and exactly where they are used. But of course, if you're cutting off supply of these things, then because China is the dominant global supplier of them, then effectively, if you're dependent on them, then it cuts you off at the knees. And so if these are rare earths that are particularly being used in industries that are of strategic importance to the US, then that will hurt them a lot. It won't necessarily affect US GDP, but it might set back efforts to build up some manufacturing in some critical areas in the US. The reason China has not done a lot of this before, they've put restrictions on rare earths on and off over the past few years, but I think there is an awareness that this is a bullet that you can only fire once, because although China right now is the global source for rare earths, they can be found in other places. And if you can't get them from China, then you've got a big incentive then to develop supply elsewhere. So in the long run, it's not a particularly effective strategy to cut other people off from rare earths, but in the short term, it could cause some pain.
Yeah, indeed. And broadly speaking, what's the impact on China's economy from all of this? Both the tariffs that the US have placed upon China, but also the retaliatory tariffs that China's placed on the US. What are we expecting in terms of the impact on China's GDP? There's one question that's just come in about 5% growth. I think we can all probably agree that a 5% growth target, or any growth target, is probably the most meaningless number in global macro these days. But is there any hope of China really hitting that? Will they have more domestic policy support to offset the hit from tariffs? What's your sense?
So our estimate, we had expected the US tariff on China to go to about 60% around now. We'd said during the second quarter as a kind of a rough estimate of when that would happen. So from the US side, it's broadly in line actually for China with what we'd expected. The US tariffs on other countries are higher than we had anticipated, but on China, not. So our standing forecasts already incorporate a lot of what has happened this week. We had estimated that a tariff of 60% or so on China would, if the exchange rate didn't offset it and there wasn't any domestic easing, would knock about 1% off China's GDP, given that we're looking at only 3% of China's GDP is generated by exporting to the US. However, we also think that there will be some offsetting loosening. We already have seen fiscal loosening announced in early March. And most importantly, we've assumed that the renminbi would be allowed to weaken to offset all of that. And that would lower the impact on China to maybe 0.5% of GDP. That call, though, that the renminbi was going to weaken had been looking a bit in question, I think, and perhaps still is in question, because actually over the past few weeks, the renminbi has still remained fairly stable against the dollar. One argument why that might have been the case has been that the People's Bank did not want to aggravate Donald Trump, didn't want to escalate the situation by having a big move in the renminbi. I think that argument no longer really stands. If they're willing to put a 34% tariff on everything that China buys from the US, I don't think they're worried about escalating anymore. In fact, they seem to have embraced escalation. So I think that there's a pretty good chance that we'll see some significant weakness in the renminbi over the next few weeks and months.
Great. We'll come back to what that might mean for the global economy and whether we're in a global trade war in due course later. But there's been a few questions about movements in currency markets. I want to come to you, Jonas. It's striking, isn't it? The textbooks tell us that currencies should appreciate once tariffs have been imposed. And indeed, that's a crucial safety valve, helping to cushion the effects of tariffs, and a key difference between the situation today and the last time we saw really aggressive hikes in tariffs in the 1930s, when, of course, the world operated fixed exchange rates. So we're supposed to have this safety valve of floating exchange rates. Instead, rather than appreciating, the dollar's depreciated and in some ways just exacerbated the effect of tariffs, therefore. I think that's a really important point that shouldn't get lost when we're thinking about the macro consequences. So what's going on with the dollar and why is it weakened, do you think? What's the explanation?
Yeah, you're right. It's not just the textbooks that tell you that's what should happen. That is what happened in 2018-19, the previous US-China trade war. It's also actually the way the market was treating tariff news just a couple of months ago. I think in the November through January, early February period, when the dollar was strengthening, when Trump was talking about tariffs. And so something flipped along the way. And I think there's two things. One is that the US economy looks like it started to slow on its own accord, even before all this started and the policy stuff really took effect. But it's also the fact that the market's come around to the view that actually the US is shooting itself in the foot with all this stuff, not just the tariffs, but the broader policy uncertainty that Trump's approach is generating. And so what that does is it's causing a recession fear. I think we're well into that territory now. It's pushing down interest rate expectations in the US. The market's now pressing in several cuts from the Fed now, with potentially starting next meeting or the meeting after that. And so interest rates expectations in the US are falling by more than elsewhere, and that pushes the dollar down. That's pretty straightforward. It's going back to the idea why tariffs should act as a cushion if it works through interest rate expectations. Because if you have tariffs that pushes up inflation, that leads to tighter policy in the home economy, or the US in this case, and you lose policy elsewhere as other economies try to offset. And that's just not how the market is seeing this. We're pushing down interest rate expectations because we think the US is headed towards a recession or a very marked slowdown. So that's odd. It is an unexpected effect. And as you say, that means there isn't this cushioning outcome for either the US or in some sense the rest of the world, because the rest of the world needs weaker currencies to support exports in this situation. The final point on China and the devaluation, the potential for devaluation there, I think an important point to bear in mind there is if China puts tariffs on US in retaliation, that's between the US and China effectively. If Beijing goes for devaluation, pushing their currency down to help offset that's spreading the pain. That's one step towards the 1930s, right? Because by devaluing your currency, you're essentially trying to export more to other countries as well. Basically, the exports that aren't going to the US go somewhere else, and someone else has to absorb your deficient demand, if you will, which is very much a 1930s dynamic, and I think it would probably lead to potentially a reversal in the drop in the dollar, because other currencies would, especially in Asia, would weaken alongside the renminbi. Yeah. In some cases, deliberately. Everyone's trying to beg out that name, is the phrase, isn't it?
Yeah, so at the moment, though, there's been various takes out there about the dollar and what's going on. It's not but necessarily behaving like an EM currency because of institutional concerns and concerns about the policymaking environment. Your fundamental judgment is that it's still about interest rate differentials and the fact that the market's now pricing in 4 cuts, and that's That's fundamentally what's weighing on the currency. Let's talk a bit about how Europe fits into this, Andrew, and the extent to which European governments might be looking at how China's responded. The UK government has said that if the US doesn't back down by May the 1st, it may respond with its own set of measures. And what about the European Union? How is it planning to respond or likely to respond, do you think?
Yeah, it's difficult to be sure what will happen. I mean, policy making in Europe is always quite complicated, but our starting point was that we thought Europe would be very measured in its response. It has a great interest in maintaining the relationship with the US for the long term, and I hope that things would reverse over time. It also is very interested in shoring up what remains of the global trading system. Europe very committed to the WTO. It's important to it in the long run again. More recently this year, they have said that they were going to respond in a slightly more firmer way than I had anticipated towards the first round of tariffs that the US announced on steel and aluminium. The plan was to match the $26 billion worth of trade with similar tariffs on a list of goods, including the famous Harley Davidsons and bourbon whiskey, but a lot of other things as well. But they're having trouble even agreeing the list on that. It's interesting that Italy and Ireland and others are opposing the tariffs specifically on bourbon whiskey, for example, because they fear escalation from the US if they were going to go down that route. In practice, of course, we've now had a lot more tariffs. Had the 25% auto tariff. We've had the 20% reciprocal tariff. Europe has said very little since then that is of any substance. They've just said they will respond firmly. They will not stand by idly. But they've also said they're open to negotiation. So we have to read the tea leaves. My own best guess at this point, though there is lots of uncertainty, is that they will eventually announce something relatively eye-catching, but they'd be hoping still that will be the basis upon which they can reach some kind of agreement with the Trump administration. So clearly that's plan A. They're pretty open about that. It's a bit more of a debatable as to what they would do if plan A does not work. If Trump doesn't back down or even partially back down, then I think Europe will feel they have to do something. Exactly what it will be remains to be seen. It may be that they target some of the service sector companies, a digital tax, for example, and maybe that they go for certainly a tariff on US auto imports is quite possible. But I think they'll be slow and cautious, and we won't see anything in the next week or two.
To what extent is that an issue? So it's interesting, isn't it, that we've seen a pretty forceful response from China. Genuine, as Mark was saying, genuine reciprocity, 34% tariff on all imports from the US coming in on April the 10th. It's the day after the tariffs on US imports from China come into effect. Whereas, as you say, Europe moves slowly, it's forged through consensus, it's trying to uphold the rules-based global trading system, all of which are admirable qualities. But do they play against Europe in this situation, do you think? Is there a sense in...
Well, I'm not sure that they do. To be honest, I think, like most economists, I think my view would be that in terms of maximizing your own output, you're probably best not to retaliate. And the only reason to retaliate really is if you think you can get a negotiated response from it. So I don't think it necessarily plays against them, though it is difficult to judge in this case. There is also a bit of a power vacuum in Europe at the moment because the German government is on the way out and the new one has not yet come in. So maybe when Friedrich Merz takes up his role as chancellor, we may have a little bit more decisive action. He has literally said nothing about this week. He's completely absorbed in coalition negotiations. Just one other thing I thought worth mentioning is that Europe will, I think, respond very forcefully to any perception of dumping or of redirection of a lot of cheap imports from China and other Asian economies that have been hit with very high tariffs. They've already got the system in place for that, trade defense instruments and safeguards, and so anti-dumping duties and things. Those, I think, will come through. And then that is just another way in which protectionism can get propagated around the world, even by policymakers who don't really want to escalate and aren't intending that happens.
Yeah, that's a good question. And we've had one question about the motivations here. Motivations on the US side. Is it the case that Trump's trying to create some market mayhem that will ultimately force the Fed into action? We get that famous Fed put. Or is there something else going on? Be interested in your take on this, Jonas. For what it's worth, my take is that that kind of suggests or implies that the White House is playing 4D chess, and I don't think they really are. I think that really it boils down to a question of, is the intention here to try and generate a permanent source of revenue for the federal government that then can be used to cut other taxes? Or are tariffs being used as a tool to exert concessions from other countries, either in the trade arena or in non-trade areas, fentanyl flows, migration, and so on and so forth? There's different views on all of that, of course, and no one knows. And there's media reports, of course, about infighting and different factions within the White House pushing different parts of those kind of different types of agendas. But what's your take? Is there any chance here that the White House is deliberately engineering chaos in order to get rates down? And might we get rates down anyway? Might we get the Fed puts anyway?
Who knows what the plan is? It's quite striking how Trump and others in the administration, you were saying yesterday, it's all going well, this is going to plan. Like, that's a pretty remarkable thing to say on the day the stock market was down 5%. Because even if lower interest rates is something Trump has talked about that he wants, and a weaker dollar for that matter as well, I don't think this is the way you'd want to accomplish that. That seems a cure that's worse than the disease, if you will. So I find that hard to believe. But it is, I think, part of what is worrying the market, the idea that Trump doesn't care what happens to equities. He doesn't care what damage he does, that he sees uncertainty as a negotiation tool. Obviously, in a business negotiation or in diplomacy, uncertainty can be a part of the toolbox and it can be quite effective. But I think if you think that from the perspective of managing the economy or financial markets, uncertainty is just toxic. It leads to paralysis. It can lead to a self-reinforcing downward cycle, which I think is what people are worrying about now. The idea of a Trump put is, I mean, at this point, it looks like you're hoping the arsonist will put out the fire he just started. But as for the Fed, there is a Fed put. There is always a Fed put. The only question is how far down do you have to go? How bad do things need to get before the Fed has to step in? And the one thing that will absolutely force them to do something, whether that's cutting rates or intervening in other ways, is if you start to see market functioning break down. And obviously the way things have gone over the past couple of days, we are heading in that direction, but we are still, I think, a reasonably long way away from that. So I don't think the Fed put is here. The Fed put is there somewhere, but it's a long way down till we get there. But if you keep having more days of extreme volatility like this, it's a bit like driving your car really fast over a bumpy road. You don't know exactly when or what is going to go wrong, but the longer you do it, the higher the probability that something goes wrong.
Leads us on to a final question, which is, where does this leave the future of the global trading system? There's been lots of commentary over the past 24 hours about the death of globalization. April the 2nd was the day that globalization died. Of course, globalization is more than just goods trade. It's services trade, it's financial flows, it's people flows, and it's more than just the US. China is not fighting with Europe, and Europe's not having a trade war with Japan. And these factories that have moved, the supply chains have splintered, they're not necessarily going to move back to the US. I think that this at the moment, there's a slight tendency, isn't there, to say this is the global trade war when actually it's a US trade war. And I think the other point that's perhaps come out of the tariff announcements from the US over the past 48 hours and the response that we've had so far from the other countries is that the US appears to have singled out China and other Asian economies more than it has singled out certainly Canada and Mexico, but also Europe, which kind of sits somewhere in the middle. And China's obviously responded more forcefully. So at the moment, it still feels to me like this is directed primarily at China. It's not everyone, but China's been hit particularly hard, and China's responded more forcefully as well. So potentially we've spoken a lot, haven't we, about the fracturing of the global economy. There's a fracturing angle to what's happened here too.
That was Neil Shearing talking to Andrew Kenningham, Jonas Goltermann and Mark Williams about the latest twist in the Trump tariffs rollout and the market's response. I'll link to the full recording in the podcast notes. There's a lot more in there, including on what's happening in markets, whether something could break as a result of all of this, but also what's motivating China's response. I'll also add some key analysis from the last 72 hours. We call these online briefings drop-ins. They are short-form sessions. They are deliberately designed to get clients the analysis they need as quickly as possible so they can get on with their day. We hold several each week on the full range of macro and market issue. Don't forget, for access to all of our analysis, including invites to all of these drop-ins, data resources, economist engagement tools, and more, check out CE Essential and CE Advanced, our all-access packages. Speak to your account manager for more information. But that's it for this week. We will be back next week with more from the front lines of global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.